Visa, MasterCard, American Express. Too many credit cards to choose from, whether basic, platinum or gold. Get me out of here. Welcome back, guys and gals, to Financial Guru, where you come for the finance and you stay to collect your free credit card. Ka-ching! Just kidding, folks. It's time for a stock analysis on Visa, MasterCard and American Express. We will first look at what each company business model is about and its history, discover a recent acquisition from MasterCard, and do a detailed financial analysis comparing all the three companies together, and then try to pick a winner for you to do more research on before possibly purchasing the stock. It's time to delve into Visa's business model. Visa Incorporated is a global payment technology company that connects consumers, businesses, banks and governments and territories to fast, secure, reliable electronic payments. It operates processing networks VisaNet, which offers fraud protection for consumers and assured payments for merchants. The company owns, manages and promotes a portfolio of well-known, widely accepted payment brands including Visa, Visa Electron Plus and Interlink, which is licensed to its clients for use in their payment program. It offers a wide range of branded payments, primarily financial institutions use to develop and offer credit card, debit, prepaid and cash access programs, as well as digital, mobile and e-commerce platform for their customers. The company provides transactional processing and value-added service to its clients through VisaNet, Visa Debit Processing Services and Visa Processing Services, which promotes and enforces a common set of operating regulations adhered to by its clients to ensure the efficient and secure functioning of its payment network and the maintenance and promotions of its brands. It invests in new services and processing platforms to facilitate more convenience and innovative payment methods such as mobile payments, money transfers and e-commerce, and continually improve the speed and efficiency, security and performance of its networks and payment services to enhance the reliability of the global processing infrastructure and protects the security of cardholders' information. The company was founded in 1970 and is headquartered in Foster City, California. History of Visa. Visa can trace its roots back to 1958 when the Bank of America launched Bank AmeriCard, the first consumer credit card program available to middle-class consumers and small to medium-sized merchants in the United States. It didn't take long for the company to grow. The company expanded internationally in 1974, followed by quickly introducing the debit card in 1975. Two changes took place in the 1970s that defined our organisation and reshaped the entire industry. First, Bank of America card became an independent entity. It was eventually united under a common global brand, Visa. Second, Visa launched VisaNet, the world's first truly electronic authorization, clearing and settlement system, which enabled transactions to be completed in seconds. These two milestones brought scale, security, reliability, and ubiquity to what was a fragile and fragmented business. Visa continued to operate as a series of entities owned regionally by banks across the world until 2007, when in the United States, Canada, Latin America, and Caribbean, Asia Pacific, Central Europe, Middle East, and African regions all merged into one as Visa Incorporated. This company went public in March 2008 and one of the largest and most successful IPOs in history. Today, Visa operates in over 200 countries and territories, and our products and services are available on any device, card, laptop, tablet, and mobile device. As we look into the future, we are tied to the vision first envisioned by our founder D. Hock to be the best way to pay and be paid for everyone, everywhere. On October 11, 2006, Visa announced some of its business would be merged to become a publicly traded company. Visa completed its corporate restructuring with the formation of Visa Incorporated. The new company was first step towards the Visa IPO. The second step came on November 9, 2007, when a new Visa Inc. submitted its $10 billion IPO filing to the US Securities and Exchange Commission. On February 25, 2008, Visa announced it would go ahead with its IPO of half its shares. The IPO took place on March 18, 2008. Visa sold 406 million shares at US $44 per share. Visa raised US $17.9 billion in what was the largest initial public offering in US history at that time. Now let's go on to MasterCard. MasterCard, originally known as Interbank from 1966 to 1969, and then changed to MasterCharge from 1969 to 1979, was created by an alliance of several regional bank cards associations in response to the Bank AmeriCard issued by Bank America. In 1966, several regional bank cards associations joined together to form the Interbank Card Association, the ICA. The interbank branding in 1966 initially consisted only of a small, unobstructive lowercase inside a circle in the lower right hand corner of the front of each interbank card. The rest of the card's design was prerogative of each issuing bank. This tiny logo proved to be entirely unsatisfactory for creating nationwide brand awareness in order to compete against the established leader, Bank America. In 1969, Interbank developed a new national brand, MasterCharge, the interbank card, by combining the two overlapping yellow and orange of the Western State Bank Card Association with the MasterCharge name, coined by the First National Bank of Louisville, Kentucky. In that same year, National City Bank joined Interbank and merged its proprietors Everything Card with MasterCard. In 1968, the ICA and Eurocard started a strategic alliance, which effectively allowed the ICA access to the European market and for Eurocard to be accepted on the ICA network. The Access Card Systems from the United Kingdom joined the ICA Eurocard Alliance in 1972. In 1979, MasterCharge card was renamed MasterCard. In 1997, MasterCard took over the Access Card and the Access brand was then retired. In 1993, the MasterCard International Incorporated became the first bank to use holograms as part of their card security. In 2002, MasterCard International merged with Europay International, another large credit card issuer, which for many years issued cards under the name Eurocard. In addition, the company introduced a new corporate logo, adding a third circle to the original two that had been used in the past. A familiar card logo resembling a Venn diagram remains unchanged. A new corporate tagline was introduced at the same time, the heart of commerce. In 2010, MasterCard expanded its e-commerce offering with the acquisition of DataCash, a UK-based payment processing and fraud risk management provider. In 2012, MasterCard announced the expansion of its mobile contactless payment program, including markets across the Middle East. In 2014, MasterCard acquired Australian leading reward program manager company Pinpoint for an undisclosed amount. MasterCard teamed up with Apple in September 2014 to incorporate a new mobile wallet that features into Apple's new iPhone and Apple Watch models known as Apple Pay, enabling users to be more readily use their MasterCard and other credit cards. The company, which had been organised as a cooperative of banks, had its initial public offering on May 25, 2006 at US $39 a share, selling 95.5 million shares of the stock. The stock is traded on the New York Stock Exchange under the symbol MA. MasterCard took steps to advance its identity verification efforts with the acquisition of eKata for US $850 million. Digital identity is a foundation part of MasterCard's multi-layered approach to security. In 2019, the company introduced a new framework on how digital interaction should evolve, as well as how digital identity will build trust, collaboration, and economic growth. The framework is now in use across a number of sectors, from education to travel to healthcare. eKata works with a wide range of global merchants, financial institutes, travel companies, marketplaces, and digital currency platforms. The company uses insight to deliver unique scores, data attributes, and risk indicators that businesses then can use to make more informed decisions. They help their customers identify good consumers and businesses and bad actors in real time during online account opening, payments, and a variety of other digital interactions. The shift to a more digital world requires real solutions to secure. A.G. Bala, president of the Cyber Intelligence Solutions at MasterCard, said, "With every edition of eKata, we will advance our identity capabilities and create a safer, seamless way for consumers to prove who they say they are in the new digital economy." eKata's identity verification data, machine learning technology, and global experience, combined with MasterCard's fraud prevention and digital identity programs, will help businesses confidently know who their customers are, and in turn help those customers safely interact online. MasterCard and eKata integrated services will build on both companies' commitment to ensure trust and responsible use of data. The acceleration of online transactions has thrust global digital identity verification to the forefront as one of the biggest opportunities to build digital trust and combat global fraud, said Rob Edelvard, CEO at eKata Incorporated. Complementary expertise, the addition of eKata's technology and engineering team will help bolster the support MasterCard and can provide as a one-stop partner for any consumer bank merchant, fintech, or government data payment and open banking needs. The combined capabilities across digital first installments and crypto payment services will help to enable greater choice and functionality with the potential to expand further to real-time payment and cross-border activities. Now let's look at litigation. A litigation antitrust lawsuit by ATM operators. MasterCard along with Visa have been sued in the class action by ATM operators that claim the credit card network rules effectively fixed ATM access fees. The suit claims that this is a restraint on trade in violation of federal law. The lawsuit was filed by National ATM Council and independent operators of automated teller machines. More specifically, it is alleged that MasterCard and Visa network rules prohibit ATM operators from offering lower prices for transactions over PIN debit networks that are not affiliated with Visa or MasterCard. The price fixing artificially raises the price that consumers pay using ATMs, limits the revenue that ATM operators earn, and violates the Sherman Act prohibition against unreasonable restraints on trade. Jonathan Rubin, an attorney for the plaintiffs, said Visa and MasterCard are the regulators, organised and enforcers of a conspiracy amongst US banks to fix the price of ATM access fees in order to keep the competition at bay. Debit card swipe fees, pricing fixing. Both MasterCard and Visa have paid approximately $3 billion in damages. The companies agreed to allow merchants displaying their logos to decline certain types of cards because interchange fees differ, or to offer consumer discounts for using cheaper cards. Now let's look into American Express. American Express is a global payment and travel company. Through its subsidiaries, offers products and services including charging credit payment cards, products, and travel-related services to consumers and businesses around the world. It focuses on generating alternative sources of revenue on a global basis in areas such as online and mobile payments and fee-based services. The various products and services are sold globally to diverse customer groups, including consumers, small businesses, mid-sized companies, and large corporations, through various channels including direct mail, online application, targeted direct, and direct response advertising. American Express operates through 4 reportable segments: US card services, international card services, global commercial services, global networks, and merchant services. The US card service segment offers a wide range of card products and services to consumers and small businesses in the United States and provides travel services to the card members and other customers. The international card service segment offers proprietors, consumers, and small businesses cards outside the United States. The global commercial service segment provides expensive management services to companies and organizations worldwide through its global corporation payments and global business travel businesses. Global corporate payments offer a range of expense management solutions to companies worldwide through its corporate card programs and business-to-business payment solutions. Global business travel provides globally integrated solutions both online and offline, as well as through mobile applications to help organizations manage and optimize their travel investments and services, their traveling employees. The classic American Express Green Charge Card was introduced in 1958. American Express diversified its holdings by acquiring companies in areas such as investment banking, insurance, and publishing. It purchased Fireman's Funds Insurance Company in 1968, Shares in Loeb Roads Incorporated, a leading brokerage firm, in 1981, which was then sold on in 1993, and Investors Diversified Services Incorporated, a large Minneapolis-based insurance mutual fund and financial advisory group. In 2016, credit card using the American Express network accounted for 22.9% of the total dollar volume of credit card transactions in the United States. Now we have an understanding of what these companies do. It's time to evaluate their financials. You will see on the screen I have listed each financial tool we're going to look at and what Visa, MasterCard and American Express are currently at financially for each financial tool. First we will look at market cap. For the people that don't know, market capitalization refers to the total value of all company shares of a stock. It's calculated by multiplying the price of the stock by its total number of outstanding shares. Currently Visa is the biggest company at $533 billion, more than 3 times bigger than American Express at $137 billion. When we look at the share price, it is staggering. MasterCard is worth over 50% more than Visa, $390 compared to Visa's $250. When Visa's market cap is $140 billion more than MasterCard. One reason can be MasterCard has less shares outstanding, and people may see more growth in MasterCard compared to Visa. When we look at PE ratio, it shows growth more clearly, with MasterCard being 7 points higher than Visa. Interesting to see American Express is so low, but the company is seen as a more stable compared to the other two, with less growth potential into the future. This is where revenue versus net income clearly show. American Express is well ahead of the field in terms of revenue, but their bottom line is very poor, with less than 20% of American Express's revenue making it out after expenses. The most impressive is Visa, with around 50% of revenue making it to their bottom line Visa with over $10 billion in net income is around 50% more total than American Express, with MasterCard trailing the pack at 40% behind Visa. Wow, American Express total assets hit MasterCard out of the ballpark with a staggering $193 billion, smashing MasterCard by an 83% at a measly $34.8 billion, which also strikes me as funny, as in terms of total assets compared to liabilities, Visa wins on percentage with just under 50% more assets than liabilities. So again, from what we have learned so far, it suggests Visa may be undervalued and MasterCard could be overvalued. But don't let American Express fool you. Being asset rich, their total liabilities are close to $170 billion, leaving them little wiggle room for long-term sustainability. With just over $23 billion more on assets, not a huge buffer. As we look at the cash on hand, why is MasterCard so low? Why has it decreased by 25% in the last quarter? Due to the great acquisition of eCard to improve their own security network of your cards and money. Sadly, it seems like this sector has a fine line between the margin of cash available to long-term debt. So MasterCard is a little concerning, but no doubt within a year they may well get back to normal after the acquisition. So surprisingly, I say American Express won this one with more than double the cash in hand compared to Visa at $40 billion. Now shares outstanding. This is a tight race, but American Express just wins with $0.82 billion, just over MasterCard at $0.99 billion, while Visa is way behind the pack at 2.44 billion shares outstanding. Remember what I said earlier when I was saying shares outstanding is one figure that people analyse for growth of the stock? As you look at the availability of shares, currently American Express and MasterCard would be more of a premium price as less stocks are available to buy to the public, which makes them more attractive for the institute investor and makes it harder for big price movements in the stock, which gives people confidence to buy and hold the stock for the long term. All three are buying back shares, but at a very slow rate, all under 2%, so that is a positive, unless you are owning more of the business than you did a year ago. Employees are a big expense for companies, and this is why American Express is struggling to get a higher net income, as they have to pay for 3 times more employees than both MasterCard and Visa. That includes more for annual leave, taxes, employees' benefits, insurances and medical, and so much more. Interesting, in 2020, American Express kept the same amount of employees. Visa increased to around 5% and MasterCard had a 13% increase in employees. Now for an investor, generally more employees can be a no-no, but if you're expanding and it is going to make you more money on your bottom line, it is a great investment. But to compare, something like Palantir is struggling with their computer analysis, as it is too complex and it needs expert humans to decipher the data making, which makes them not that profitable, as an example. Now imagine American Express cutting half its employees today. It could continue to run the business at current levels. There would be a 50% increase on the bottom line, as you're not paying the employee cost. That is what Uber has done, but not to that extent. So it's only a positive if your business is going to continue to run like clockwork, or at least gain 20% on the bottom line. Then it is worth it to do it for the business, but not great obviously for the employees. Dividends, well, not much to write about here. The dividend is that small currently, it's not really worth even looking as a dividend play for dividend investors, with them all under a 1% dividend yield. Similar to Apple, it's a token gesture, but really not worth your time with taxes. But if it did jump up 2%, but more ideally 4%, now you're talking. But these stocks are more solid. They do have potential for growth into the future. Dividend payout for each company are very similar, with each company comfortably able to afford the dividend with 22.2%, the highest with MasterCard. So they all have about 80% more money left over that can cover the dividend. This is a positive and more likely to see these credit card companies keep the dividend going as they can afford it. Compared to travel stocks like cruise lines, airlines, Disney, mostly all getting rid of their dividend just to survive. Dividend increases for 12 years on Visa and 10 years on MasterCard are very promising. Sadly, American Express hasn't raised their dividend going on 2 years now, but I guess at least they are still paying it, but also they are becoming more cash strapped going forward. Now let's look at sector comparisons for gross profit margin. Wow. All these companies are going well with gross profit, meaning most of their revenue has little operating expenses, with MasterCard and Visa basically having very little cost, where American Express has a little bit more, but that's to be expected with 3 times the amount of employees than the other two. Gross profit is healthy for all of them and all above the sector average. we will now look at sector revenue growth. With the sector average of 14.5%, both Visa and MasterCard are in the negative, where surprisingly American Express is up 11.31%. So revenue growth is not that great for the two bigger companies, and you would hope that this would improve into the future. Lastly, we're going to look at price to book ratio. So what is price to book ratio, or PB ratio? Is where a company compares a firm's market cap to its book value. It's calculated by dividing the company's stock price per share by its book value per share. As an asset, book value is equal to its carrying value on the balance sheet, and companies calculate its netting the assets against the accumulated depreciation. Book value is also a tangible net asset value of a company's calculated as total assets minus intangible assets like patents and goodwill and liabilities. In simple terms, for the lower the figure, the more undervalued the company is perceived to be, and this is where Visa comes to the party. American Express is the lowest at 5.38, but considering the size of Visa, 14.23 is very low, compared to MasterCard at a whopping 60.2% book value. So MasterCard is 4 times more overvalued than Visa, but on pure figures, American Express wins the PB ratio. Now, which stock do you buy? After taking all this information in, let's summarize the positives and negatives for all. Visa's positives are they have the biggest company in terms of market cap, the most income dollar value, revenue to net income is around 50%, which is amazing. Total assets minus total abilities are again around 50%. They also have the best dividend increase of 12 years consecutive growth. The sad news is though that their shares outstanding is 3 times larger than the other two companies. They have the worst revenue growth over the last year. So now let's look at MasterCard. MasterCard's positives is they have had the new acquisition. It seems to shore up the security of their card, have the highest share price, so people believe in the growth of the company and see the company as a premium in the sector, just like Tesla for cars, Domino's Pizza for food industry. But MasterCard has the lowest long-term debt and total liabilities, which is a real positive. MasterCard really know how to keep expenses down. Dividend increase is very strong for 10 years consecutive. MasterCard has some flaws, including the share price can be seen the opposite way, it's overvalued, with the price to book ratio at 60. Revenue and net income is much lower than the other two companies. They don't have much assets, with over 5 times less than American Express. And also their revenue growth is very poor and minus 9%. American Express, to me, I'm not really interested, and even though their share price is the lowest and have a low PE ratio, the most revenue and the lowest price to book ratio and shares outstanding, they have way too many expenses, and with a workforce of 3 times more than the other companies, total liabilities and long-term debt astronomical. It's a pass for me as a long-term growth play. So that leaves MasterCard and Visa. With all 3 companies, their biggest issue is they rely on credit cards. If they were all to go obsolete, the business would die. But that is highly unlikely in the next 50 years, but you never know. I'm more on the side of value growth investing, so Visa to me is the hands down winner. But to be fair, most investors seem to like MasterCard more than the others, and at the moment you could consider MasterCard as like the Bitcoin, where Visa is like Ethereum, or MasterCard is like Tesla, and Visa is like Neo, to the idea in terms of what the stock market believes. But to me, Visa has more growth in price on current metrics, but MasterCard does have a better control of long-term debt and total liabilities. So something to ponder. I think you can't go wrong with either Visa or MasterCard. I believe over time both are easily going to go to $1,000. It may take 20 years to get there, and slow and steady will win the race. Buying in and out of stocks, only 1% of the whole population around the world make a profit through day trading and short-term trading. So long-term investing is the safest way to early retirement. Doesn't mean you don't have to take risk. Visa to me is a steal at current prices, but if you get a reasonable dip, load the boat. Time has come for me to go. Remember to thank your guru and smash the like button so we can share the love of finance all over the world. Subscribe to my channel would be very much appreciated so I can make more of the videos you love. I am not your financial advisor. Be sure to seek professional advice before buying any stock or cryptocurrency. Until next time, I better do some online shopping at Amazon, buy me some Domino's Pizza using Uber Eats, buy me more crypto and put some gas in my car. Use your credit card wisely, guys and gals. Get your credit score up, but don't put yourself into major debt. That is what rental investing is for. Financial Guru over and out before my line of credit runs out as I hit Wynn's Resorts to try my luck at blackjack or the slot machine at the casino. I'm just kidding, folks. Take care out there.